Welcome to This Week in Money. I'm Phil Mackesy. Today, Andre Gerolymatos updates us on Greece, John Rubino on why markets are rising, and Dave Skarica with a wrap of the week's activity. We begin with Andre Gerolymatos right after this.
American Manganese Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
Welcome to This Week in Money, the source for market opinions, brought to you by AmericanManganeseInc.com. Here is Phil Mackesy.
Professor Andre Gerolymatos is chair of Hellenic Studies at Vancouver's Simon Fraser University, and he's an expert on modern Greek history. You can find him on Twitter at SFU Hellenic. Andre, the key word in the financial press this morning, optimism. Chancellor Merkel and Prime Minister Papademos optimistic that they are close to a deal on that $170 billion bailout. Sorry, not a bailout, a rescue package is what they're calling it now.
Exactly, yes.
Give us a sense of the mood of the Greek people. They are obviously not optimistic about this. They're suffering pretty badly.
Well, for the Greek people, this is the fifth year of very deep recession, having suffered through, really serious cuts and watching their standard of living erode dramatically. So I think at this stage they're not optimistic. They're just resigned. There is a small, minority that of anarchists that will take to the streets.
Sure.
And burn things. But I think, as Mr. Mitsotakis, who's visiting SFU, as a member of Parliament, has said, Greek people are in survival mode. And I think that's the most apt description.
So Kyriakos Mitsotakis is the guy we're talking about. He is a Greek parliamentarian who has a lot of experience in what's going on there. What else did he have to say yesterday?
Well, he voted for the package. His concern is that the Germans and some of the other northern European countries have pushed Greece to the brink. It's almost vindictive. He understands why they're doing it. He understands that the inability of the Greek political leadership in the last 2 years, broken promises of trying to fix anything. But, the way they're going about it, and even after they voted for it, right, by dragging their feet to sign the package, it's basically undermining the people who voted for the package.
Mm-hmm. Now, there are actually two separate parts of this package. The first part, apparently they're going to split it into two pieces. The first part will be the bond swap. Can you give us some details about what's happening here? Why is this a bad idea?
Because, at the end of the day, it doesn't do anything. In both packages, right, do not take into account any possibility for growth. They're taking a country, putting it into incredible debt with no option to get out of that debt. What happens when all that money is used up to pay foreign bondholders? The Greeks are in a huge debt, and their economy has shrunk further.
Here's some pretty hard numbers here. The Greece has to reduce its debt from 160% of GDP to 120% by 2020. And to do all this, there's a lot of harsh austerity measures being imposed.
And some of them, don't make sense. For example, they're imposing a cut in the minimum wage for private employers. The private employers have not asked for this cut. Yeah. Most of them are not going to go along with it because they think it's counterproductive. And, when you cut people's, the minimum wage like that, they're not going to go and buy anything. So that economy, again, is not going to grow. And it seemed like a senseless thing to do.
Mm-hmm. And speaking of senseless, here's one of the strings attached to the bailout. How do you feel about this? Greece has to agree to international monitors, basically on a permanent basis. In other words, international babysitters.
Well, it's also an infringement on Greek sovereignty. You see, these are these little irritants that, remember, there's an election coming up at the end of April, and it's going to make it very difficult for the two mainstream parties to even form a coalition. And there's a lot of hard feelings in Greece about the Germans in particular, and this kind of punitive approach that they're taking towards Greece. In relation to, what's happened in the past in history, what Germany has done to Greece during World War II, one of the fundamental reasons why the Greek economy, why the Greek state is in such shambles, is because its roots are, really only go back after World War II, And that was because the country was so devastated by the war.
Now, you touched briefly, Andre, on elections. Could be coming up as early as April. The conservative leader, Antonis Samaras, says he will make changes if the economy needs them. And, of course, a lot of countries are now nervous, saying maybe we should put the deal off until after the election.
Well, the problem, if they do that, then Greece will go into an uncontrolled default, and it will suck in Europe with it. I mean, there are some voices in Europe, and again, coming from some quarters in Germany and Finland, that they believe that, Greece is a special case. This is some of the rhetoric that's been bandied about. And, it's different, and the Greeks are just strange people, and they go and want to affect Europe. Let me give you an example that Mr. Mitsotakis gave. Lehman Brothers, which was, in fact, a medium-sized bank, when it went under, look at the impact it had. And that's a medium-sized bank. Now, we're talking about a country with a $350 billion debt. If it goes into an uncontrolled default, the consequences are going to be horrendous.
Speaking of rhetoric, we've got some statements here from German Finance Minister Wolfgang Schäuble, who says Greece is a bottomless pit. Now, should this guy be sticking to economics and steering away from statements like this?
Oh, absolutely. He should look at his own history before he points the finger at other countries. This is not, excusing what Greek politicians have done in the last, 2 years or 5 years, but I think the man is not very smart. These are not intelligent comments for a responsible member of a government, and also somebody who's part of the European Union.
Mm-hmm. Here's another quote from a European member of Parliament, and his name is Nigel Farage. He blames, of course, the IMF and the European Central Bank for the violence. Says, if I was a Greek citizen, I would have been out there joining those protests. I'd be out there trying to bring down this monstrosity that has been put upon the Greek people.
Well, he's not that far off. A lot of people feel that way. And like I said, if they would have done this package and had they been positive in their attitudes towards the Greek people and towards Greece, it would have been possible for this thing to be swallowed by the Greek people. But this sort of very arrogant attitude, this punitive attitude, is going to make it very difficult for anyone to form a government at the end of April. And who is going to be the government, of course, is a big question mark.
You mentioned earlier that your special guest, Kyriakos Mitsotakis, was in town talking to his friends at SFU. How did he feel about solutions? Did he have any ideas on what kind of a solution would be worthwhile here?
Well, there are certain big items that can be done away with very quickly and that will lower Greece's debt. For example, privatizing the railway system. It is a huge albatross. It's a deficit. It brings a deficit of about 2 billion euros a year, and it doesn't service very many people. So, it wouldn't be missed. So, closing something like that would send a very positive signal to Greece's debtors that Greece means business. Also, he was pointing out that a lot of structural changes have been taking place. You don't see them. It's not really sexy stuff, but things that will have a strong impact in the near future. And he was saying things like, cutting the wages, for example, of civil servants is not the way to do it, because all you do is you're promoting corruption. If somebody's not making enough money out of their salary, they're going to look at ways of getting bribes, right? His solution was cut the civil service, fire more people, but keep the ones that you keep and pay them well.
Apart from the railroads, what else would he privatize?
That's as far as he went. I mean,
Okay.
it was a general discussion about what the situation is in Greece.
So apart from privatizing railroads, what else can be done to bring things back to normal?
I think the best thing that can be done is to really change the framework of doing business in Greece, and that is changing the labor codes, minimizing bureaucracy, making it easy for people to invest. There's a huge Greek diaspora, and if you speak to anyone in the diaspora and you say, go invest in Greece, they'll say, are you out of your mind?
Mm-hmm.
Because when they go there, they face this mountain, of bureaucratic malaise that they have to go through in order to invest. Eliminate that, and I think that will go a long way in helping the country.
Now, everybody uses the word contagion here as if the problems all started in Greece, and we know for sure that they didn't. What about other countries like Portugal, Spain, and Italy? What's happening there?
Well, they're watching very closely what's happening in Greece. What surprises me is that their lack of solidarity with Greece, because I think they feel that if Greece is the whipping boy, then they'll somehow escape.
Yeah.
They're not going to escape. They're going to go through the same pain. And, in France, for example, they raised the retirement age by 1 year, and there were 1 million people in the streets. Okay?
Amazing.
So imagine what happens in France when you lower people's wages. You might have 10 million people in the streets, another French Revolution.
Yeah.
in the context of Europe, and even if the pictures that we see in Athens look fairly violent in downtown Athens, the people of Greece have pretty well swallowed this fairly peacefully. I don't think it's going to be the case in Spain or Italy or Portugal or France or Ireland.
What about places like Germany, what they're calling the paymaster of the euro? What's the general mood there?
I think the German people have not been told the truth by their leaders, which is that Germany's assets are Greece's debts, if you like, right? Germany is a powerhouse, an economic powerhouse, and they've been selling their wares to the Europeans and to the international community. However, they got to realize that, Europe is their market, and if they destroy their market as they're doing in Greece, well, they're not going to buy from them. They won't have the money to do so.
Andre Gerolymatos is our guest here on This Week in Money, and a lot of people are assuming that because the ministers are meeting on Monday that Greek default is now off the table. Is it clear sailing ahead, Andre, do you think?
Well, it depends what they do on Monday, right? I mean, I'm cautiously optimistic that they've learned that if they push them much further, the Greek system will just collapse. So they may go ahead and sign.
What about a potential bailout for Greece and its effect on the dollar? Is it going to hurt the dollar, and what will it do for gold? Any idea?
I think as long as there's chaos, in the world, including chaos in Greece and also the Middle East. I mean, look at the neighborhood that Greece is in. I think the price of gold will keep going up.
Now, you've been talking quite a bit about Syria. What's going on there?
Well, as you can see, it's a very sad, very tragic situation. The government, killing its own people. I mean, it's unacceptable. But because of the international power dynamics of Russia, China, the United States, and Europe, effectively there's nothing that anyone can do, because every time they go to the UN, either it's a toothless resolution or it's vetoed by Russia and China.
You're an expert on international security. What's your take on the latest UN resolution? Pretty useless, I would think.
Yeah. Waste of paper.
What's the security situation in Greece these days? Let's talk about Greece again for a second.
So far, it's very good. I mean, there are organized anarchists. There are about 1,000 anarchists in Greece who, operate in Athens and some of the other larger cities. And they take advantage of a peaceful demonstration, and go ahead of it and throw Molotov cocktails. Eventually, people are going to get very tired of them. A lot of them do get arrested, and I think that problem would go away. Unless, of course, the Europeans withhold the package. And then for the Greeks, there'll be a message that, look, no matter what you do, these people are not going to help you. They don't understand. And then it's chaos. Let's
assume we get a bailout going forward on Monday. What do you see from that point on? What do you see going forward for Greece?
Well, a lot of major structural changes. I mean, the political establishment, number one, will have to find a way to have a coalition government. I don't think any party will have the ability to form a majority at the end of April. I think more intelligently would be to postpone the election in April, because going to the polls under these conditions will have a fragmented parliament and a difficult thing to create a coalition government, of reasonable mainstream parties like New Democracy and PASOK. I think putting it off for a year, maintaining a kind of technocratic government with a smaller cabinet would make a lot of sense, and also I think it would reassure the Europeans.
I want to ask again about your friend, Mr. Mitsotakis. Was he optimistic about the future of Greece?
Yes, he was actually very optimistic.
In what sense?
Well, he sees that his generation, is taking over. They don't have the liabilities and the bad habits of the older political class. They're Western educated. They're very bright. They know how to make things happen. And they're also very much aware that it's imperative to get investment into Greece. So I think people like him would make the country work.
We will keep our fingers crossed Monday and the upcoming weeks for the good people of Greece. Andre Gerolymatos is chair of Hellenic Studies at Vancouver's Simon Fraser University, and he is on Twitter at SFU Hellenic. Andre, thanks for your time.
You're very welcome.
Coming up, John Rubino on This Week in Money.
Always consult your investment professional before making any investment decision.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol MOR. Website mollycord.com or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
John Rubino, our guest on This Week in Money. Visit John's website, dollarcollapse.com, your ringside seat for the global financial crisis. How you doing, John?
I'm great, Phil. How are you?
I'm doing great. U.S. stocks having a pretty good week this week, and there's a fascinating piece on your website, Gordon Long over at goldseek.com, who asked the question, why does the market keep rising? A great question.
With all the crazy stuff that's going on in the world, you would think that equity investors would be a little more worried than they are. But Gordon Long says, and I totally agree with this, that there's so much liquidity being pumped out by the world's central banks that some of it is flowing into equities, and some of it is flowing into oil, which is going up lately too, and precious metals have bounced off the lows from their recent correction. So we're basically we're seeing a liquidity-driven market that is really broad-based right now. And he's got some good charts in this article, one of which is the balance sheets of the 8 major central banks.
Yeah, that's a shocker.
And it shows them in a long-term up channel, and right now liquidity is at the high point of the up channel. So lately, a lot of extra liquidity has been pumped into the market. So it's not really a surprise, given the numbers that are involved, that equities should respond to that. And which makes me just extremely nervous, because there are so many things waiting to blow up out there. With the U.S. stock market in particular at a multi-year high now, it's easy to see, Iran blow up, or Greece, or Portugal, or some other thing. And Japan is in the news lately for their horrendous balance sheet. So something could happen to knock the wind out of equities here and make being long a horrendous idea and being short a great idea. But lately, it's been the reverse. It's been very smart to be long U.S. equities and ride this wave of liquidity.
Is all this extra cash just adding fuel to the fire?
Well, when you liquefy the system the way the world's central banks are doing and the way the world's governments are doing with deficit spending, you get a certain result, but you have to look at the other side of the balance sheet. You have to look at how much money you had to borrow to get this result. And by any measure, for instance, if you take the number of U.S. jobs created per dollar of deficit spending in the U.S., it's horrendous. And any other measure you want to use, it looks very bad. We're not getting a good return on our borrowing, which means we're going to end up at the end of whatever is happening right now with even more debt than we started with, and an even bigger collapse in prospect at some point. And so we're not fixing anything. Even if unemployment continues to trend down in the U.S. and growth were to pick up in Europe, and things from a top-line perspective, from headline number perspective, look reasonably good for a while, under the surface, things will continue to get worse because we're borrowing horrendous amounts of money in order to get these results. And so we're kicking the can down the road, as the very common term is used now. And at some point, we end up with even more debt and things blow up. And so we haven't fixed anything.
Interesting. In this piece, Gordon Long is saying there's almost $420 billion of hot money going into the market. And he says the money is not flowing into the U.S. stock market. Does that surprise you?
Well, it's flowing into a lot of different markets. I mean, U.S. stocks are up, but so is oil, and which is kind of a self-limiting trend. The higher oil goes, the more money it sucks out of consumers' disposable income, and the lower consumer spending is going forward. So you're seeing the liquidity that's being created flow into a lot of different sectors and have varying effects in different sectors, but generally positive. And that shouldn't be a surprise. And the question is what happens when the liquidity gets turned off, or when interest rates go up, or when something happens out there to change market psychology. Then we're left with all this extra debt.
We're talking to John Rubino on This Week in Money. What about these trigger points that Gordon Long is talking about? Number one, that margins have collapsed and short interest has been crushed.
That would make sense, because there were a lot of shorts a year ago out there that have all ended up underwater because the vast majority of stocks are up in the last year. And see, that tends to be a bearish sign going forward. When you get a lot of shorts taken out of the market, you have less buying pressure in the future, because a short position is an implicit long position in the future, because the stock has to be bought back in order to close out the short position. So you lower the number of shorts, you decrease the amount of buying in the future. So that's a bearish indicator, and one that isn't a surprise given what's happened in the last couple of years.
John Rubino, our guest on This Week in Money, and the piece is called Why Does the Market Keep Rising? It's Gordon T. Long over at goldseek.com. You can get the link from John's website, dollarcollapse.com. I'll focus on this weekend, and the next couple of weeks will be on Greece, and you've got some interesting news on Greece.
Well, yeah, you see a lot of speculation in the market that Greece is just going to default, leave the Eurozone, and go back to the drachma. And on the surface, that seems like the simplest alternative for them, because staying in the Eurozone carries a lot of burdens that it doesn't look like the Greek people are willing to bear.
Yeah.
But I just finished writing a magazine article on the worst-case scenario for the Eurozone, and I interviewed some analysts who are looking at what could happen, and some international lawyers who are advising companies who have exposure to the Eurozone in general and Greece in particular. And it turns out it's not that simple for a country to leave the Eurozone. For instance, if Greece were to announce today that it was leaving, it was going to go back to drachmas, and devalue the drachma dramatically in order to improve its trade competitiveness, you would instantly see a run on all Greek banks as everybody pulled their euros out and tried to move their euros to safer locations so they didn't get devalued drachmas in their bank accounts when they wake up on Monday morning. And so you'd see runs on banks, which causes the whole Greek banking sector to have to shut down, which would send Greece into a depression. So for them, it's not actually that good of a deal. But the real serious effects come afterwards, because as soon as this happens to Greece, everyone starts looking around for who's next. And they say, oh, Portugal, they're almost in as bad shape as Greece. So Portuguese banks experience a massive run and are shut down, and the government has to impose capital controls, and you get a Greek situation in Portugal. And then they go on to the next one. So you have these dominoes falling in all the peripheral Eurozone countries, which, according to some analysts, will cause basically a big bang breakup of the Eurozone. Just so many countries are hit with bank runs that there's no way for the European Central Bank to provide enough liquidity to save them all. There's no way for Germany to take all their debt on Germany's balance sheet, because there's just too much debt out there. And so the system just spins out of control. And then, the results of that would be a continent-wide depression. So now you have an idea of why everybody's working so hard to keep Greece in the Eurozone, because the possible ramifications of them leaving are so catastrophic that no one wants to risk it.
So Greece, in a sense, is the canary in the coal mine here.
Yeah, well, or the first domino, or
sure.
The idea that a country with 2% of Eurozone GDP, which is what Greece has, is able to exert this much damage and this much control over the rest of the system, kind of implies that the system was badly designed to begin with, or that it was designed in order to fail, in order to allow the more powerful Eurozone countries to exert more control. What might end up happening is that we get a fiscal union in which you have a strong central government that's dominated by Germany, that's able to determine, to an extent, the budgets of the peripheral Eurozone countries. And so you'd get political control and economic control along with monetary policy control, basically in the hands of Germany. And I'm not sure which is a scarier prospect, whether they set this thing up without realizing that it had all these fatal flaws, or they set it up with the flaws in mind, and we're hoping for something like this to happen to allow them to take the Eurozone to the next level of integration. Either way, it's a scary prospect.
Are we starting to realize that the Eurozone was a bad idea from the get-go?
Well, it's easy to understand the motivation for it. I mean, Europe had probably the worst half-century that any continent has ever experienced in the first half of the 20th century. And ever since, they've been progressively increasing the level of integration among the continental countries on the assumption that if you own factories here and stocks there and your kids are working in this other country and your parents live in over here, that it's less likely that you'll want to go to war, because the downside becomes greater and greater as your integration increases. And so that makes a lot of sense. And the euro as a common currency, in that sense, is just the next step in the integration process. But you can see now in retrospect that it was set up with some major flaws, because the countries, especially in the periphery, who are not Germanic in their attitudes about saving and investing, are forced to live under the same kind of currency regime that's comfortable for Germany and France and a couple of the other more solid European countries. And so it doesn't seem possible at this point for everyone to adapt to the same standard. And so it's possible that more integration was needed before they went to a common currency. And I don't know. I won't pretend to be an expert on this kind of a design, but it looks like the flaws are going to bedevil the Eurozone for at least the next few years, and maybe for a lot longer.
We'll keep our fingers crossed for Greece, but of course you've already mentioned Portugal. You got a great piece on your website, dollarcollapse.com. What's next for countries like Spain and Italy? They have to be watching what's going on very, very carefully.
Well, the European Central Bank has funneled enough money into the system that Spanish and Italian bonds are selling in the marketplace. They're able to borrow to fund their near-term deficits. And so they're not in immediate danger. But they're long-term, their numbers still don't balance. They still are running large deficits, which means they're accumulating more and more debt. And they haven't reformed their labor markets to the extent that they're competitive in the global markets. And they're vulnerable to the kind of contagion that we just talked about. So long-term, they've still got big problems. And short-term, they're okay unless Greece, Portugal, and Ireland blow up. And so, again, that's why everybody is so intent on keeping Greece in the Eurozone and getting them to impose austerity and try to solve their budget problems that way. But, of course, there's another problem with that. And that is that you can't really grow your way out of a deficit if you can't devalue. If you just cut wages and raise taxes, basically all you do is suck a lot of money out of the private sector and send your country into a recession, which requires more government borrowing, which requires more austerity, and you enter a death spiral in which you end up somewhere in what we would call a depression. Somewhere in 10 or 15% decrease of GDP and much lower wages. And will the electorates put up with that? It's unlikely that you can get elected in Greece or Portugal on that kind of a platform. So every election is going to be a throw the bums out event, and every new government is going to come in more or less opposing these austerity plans and then have them imposed on them by Germany and France, and then the cycle will begin again. And it doesn't look like there's any kind of a solution under the current currency regime.
John, you've been casting a skeptical eye on fiat currency for as long as I've known you. How's all this going to affect the U.S. dollar?
Well, in the short run, it's probably good for the dollar if the Eurozone has trouble, but the ultimate result of what's going on in Europe is going to be that the European Central Bank will have to liquefy on a scale that we haven't seen yet, and to enable all these governments to keep on borrowing. And the Eurozone will probably have to do a quantitative easing program like the U.S., where they buy a lot of bonds and then shovel out a lot of euros into the market to keep the system liquid, which is basically the currency war scenario.
Okay.
This will push the euro down in value versus the dollar, which will hurt our trade flows and cause our exporting industries to start screaming, and then force us to lower the value of the dollar. And you get a race to the bottom in which fiat currencies in general are debased at varying rates until nobody wants to hold them at all. We're going to lose faith in the concept of paper currency at some point. That's why gold and silver are up, because a lot of people are getting this, and they're starting to switch to the kinds of money that the central banks of the world can't destroy. And what's happening in the world right now and the policy choices that the major governments of the world have basically taken implies that this is going to go on for a long time. We're not, in the U.S., we're not cutting our deficit. We're actually increasing the amount of borrowing that the government is doing. In Europe, they're being forced, the core countries are being forced to absorb a lot of the debts of the peripheral countries who are continuing to borrow. So their debt is going up too. And so the need for central banks to continue to liquefy the system is only going to grow, which means the amount of paper that's going to flow into gold and silver will only grow. And it seems like over the next 5 years, precious metals will be a spectacular investment. There's no way to know what happens this year or the next 6 months or whatever, but over a longer period of time, these policy choices that we've made have to manifest as weaker currencies and stronger gold and silver prices.
John Rubino, our guest on This Week in Money. You can find John online at dollarcollapse.com. John, thanks for talking to us.
Great. Thanks, Bill.
After the break, Dave Skarica on This Week in Money.
American Manganese, Inc. has a manganese deposit in Arizona. Indicated 6.7 billion pounds. Inferred 8.9 billion pounds. Potentially the lowest cost producer of electrolytic manganese, costing only 44 cents a pound. Metal trading near $2 a pound. Do the math. Trading symbol AMY. Visit AmericanManganeseInc.com or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at TalkDigitalNetwork.com.
David Skarica is our final guest. He is author of The Great Supercycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. You can find Dave on the internet at addictedprofits.net, and we're always glad to have him here. Welcome, Dave.
Thanks for having me.
Let's wrap up the markets. The Dow ending the week a shade under 13,000, the S&P 1360, and the NASDAQ within shouting distance of 3,000. It's been a pretty good week, has it not?
Yeah, and actually I kind of expected that this year. One of the reasons I was so bullish coming into this year was all the bearishness we saw at the end of last year. I thought there would be a resolution to these debt crises in Greece and Europe. And, I'm not someone who thinks that austerity means no economic growth, because I don't think government spending even causes real economic growth. So you look at places like the UK where they're cutting back, are actually seeing some okay economic numbers coming out of there. And then if you look at the NASDAQ, for example, it's breaking out actually to new multi-year highs. I think the highest levels in 10 years since it was coming down below 3,000 on the downside during the tech bust in 2001. And the S&P's right at a resistance level, and the Dow is just starting to perk above its highs of last year. So I would think that we're getting overbought. At some point, we're going to see a pullback. But I think that will just be like whatever, a 3 to 5, maybe 7% pullback at the most, a correction-type pullback before we continue higher into the spring and maybe later into the year.
5% pullback, not a bad deal. Dow up 6% year-to-date, S&P up 8%, the NASDAQ up almost 13% year-to-date.
Yeah, and if you're someone who believes in the January indicator, and I like a lot of seasonality and seasonal indicators, that's, we saw the great first week of January, we saw a great first month in January, and, if you're into the Super Bowl indicator, the Giants one, which is bullish for the market. So actually, all the seasonal indicators, which say, as January goes, so goes the rest of the year, look pretty good here. I don't like to be too overly, one-sided. And like I said, I don't like to buy breakouts. I don't like to buy too much strength. So right now, in the short term, I'd be cautious. But I definitely think at some point when we do get some kind of correction, that's a correction from a trading standpoint that should be purchased, not something that, you should short.
Focus on Europe, obviously, and Greece most of this week and the week coming up with the Eurozone meetings on Monday. How much of a factor in the markets is that? Do you think it's already priced in?
Yeah, but one thing I've made the comment of is that markets tend to move when you have news. That actually tends to be kind of an inflection point. Like, for example, you look at when Lehman Brothers blew up in 2008. Well, we continued lower for like the next month or so. That was essentially a bottom in the market. Because that was the capitulation. So if we do see, some sort of structured default in Greece or something of those lines at some point, that is probably going to coincide, has been discounted in the market. Just like I think this short-term kind of bottom in Greece has been discounted as well. So I think it has been discounted, and I think that they keep putting it off so long. It's not just them not having a plan. I think one reason that they're kicking the can down the road, as they say, is because they want the banks to be able to continue to build capital and then be cushioned against a potential default in Greece. And as of now, in the short term, it looks like the only country that is going to default is Greece. I think Italy and Ireland will be able to make it without defaults, and Portugal and Spain might need some restructuring, but I don't think they'll need a full-scale default.
Sentiment seems pretty bullish these days. Not surprising that you're expecting some kind of a pullback. Hard to pick a time frame on when that will happen, and we're looking at any kind of event that could twig this kind of thing. What do you see going forward in the next couple of months?
Well, again, I think that we will have some sort of pullback, and it's just a question of right now we're at the resistance levels for the Dow and the S&P. Do we kind of hit our head on this resistance and pull back from here? Or like the NASDAQ, for example, is broken out. Do they break out kind of like the NASDAQ has and then pull back like the old resistance then becomes support? So, for example, you look at the resistance roughly at 1350, 1360 in the S&P. Does it go to 1400, pull back to 1350 before moving higher, or does it pull back right here? So that's something that's almost impossible to determine because, as you just mentioned, trading in the short term is very, very, very difficult. But I'm someone, again, who has this philosophy that when I'm trading, I rather buy at 1350 on a pullback than buy 1350 on the breakout. I just feel more comfortable when you do get some fear into the market, when you do get some negative sentiment into the market. So right now we're seeing positive sentiment. But I think one thing we have to remember is that last year, you look at all the technical indicators, like the VIX went to 46 during the correction of the summer-fall. We had really high levels of fear over the European crisis. Those kind of levels of fear usually lead to rallies that tend to last at least 6 months to a year. So even if we've kind of got a little bit of complacency now, when you go back and look at the type of fear that we had in the middle of next year, that's pretty positive for a continuation of a rally after any kind of temporary pullback.
We're talking to David Skarica on This Week in Money. Always interesting to follow the behavior of the herd. CNBC reporting a record amount of money, David, going into investment-grade bond funds this week. $3 billion a week going into bond funds.
The bonds are a bubble. Obviously, a lot of investment bond funds or some corporate bonds, which I don't see as being as large a bubble, but definitely bonds on the government levels, where you're only getting 2% a year over a 10-year bond in the U.S., 1% over 10 years in Japan, 2% roughly in other places like England and Germany and Canada. That, to me, is unsustainable. Yeah. And the amount of cash flow you're seeing going into those bond funds, again, it's reminiscent of what happened in tech funds in the late 90s or what happened in real estate in the mid-2000s, that it's kind of a blow-off or something, because something has been working, people keep piling their money into it. An interesting note is despite the fact, and I've been more bullish on equities the last 2 years than bonds, and even though bonds have had a nice move, equities have actually outperformed since the bottom of the market in 2009. We've seen actually a net outflow in stock funds since March 2009, despite the fact that the stock market, the S&P 500, has more than doubled in that time frame. So again, I just think that's a sign that we've kind of got this, even though short-term sentiment's overbought, we still have this kind of negative sentiment towards equities because of what happened during the financial crisis, and people still think that bonds can't go down or no less proposition. Now, obviously we've got the Federal Reserve buying, so you've got that kind of as a buffer to the bond market, but at some point, remember, if yields go from 2 to 3%, you're going to lose 50% on your bond investment.
Yeah.
So I think at some point, just even a small backup in yields is going to happen, and you're going to see these bonds go down a lot. But the problem with bubbles is there's an old saying, the market can stay irrational longer than you can stay solvent. The problem with all these bubbles is they always seem to go up longer and further than you always think. So, who knows? Maybe the yield on the 10-year bond will go to 1.5%, or even Japan style 1%, before it kind of rolls over. Now, it does look like the bonds are starting to temper the gains. They have been unable to break the highs of late last year, so maybe we're in a topping pattern. But I definitely think all the sentiment indicators, the kind of inflows you're talking about, are definitely signs of some kind of bubble or extreme sentiment blow-off in the bond market. And at some point, that's going to come out of the market. And what's interesting about that is twofold. I think that's going to be very positive for precious metals. People say, hey, you get higher interest rates. How is that good for gold? It's a competition. But when people are losing 20, 30, 40% on the principal price of their bond, they're not going to look to double down. They're going to get out and cut those losses and probably move it into other areas of protection. And I think gold and precious metals will benefit from that. Remember, in the 1970s, interest rates went from 3 or 4% to 15 to 20%, and gold went up at the same time. Part of the reason was people were getting so killed on the price or principal of their bond, they weren't looking to take advantage of higher interest rates, and actually gold benefited from that.
We tend to think that bonds are safe and they give us a yield, so it's okay. But we've got to remember, again, when interest rates go up, you're going to get slaughtered in bonds.
Yeah. Even if you look at a bull like Gary Shilling, Gary Shilling has even stated that he doesn't really care about the 2% on the 10-year bond. What he cares about is that if it goes to 1.5%, you get about a 25% gain in the principal of the bond. And, Shilling has been rightly bullish on bonds for years and years and years now. And, I think that's going to change at some point. But that also works on the downside, that people think, I'm buying this 10-year bond because I want to get my 2% a year. Well, what they don't realize, if yields just back up to say 2.5%, boom, you've lost 20% on your principal of it. So you essentially lost 20%, roughly 2% a year. You've lost roughly 10 years of interest in the bonds just by interest rates backing up by 0.5% from their current levels.
Interesting quote here from an analyst in the CNBC story. He says we're seeing a top in bonds. He feels the better choice right now is undervalued stocks. What do you think?
Well, if you look at, for example, the stock market, I don't think it's like overly valued here. If you actually look at the price to earnings ratio, the forward of the S&P, the earnings should be about roughly $100 to $110 this year, which at a 1,300 S&P is actually okay. You're talking about 11, 12 times earnings. That's why I say, and I think guys like Mark Faber have also said this, that if you have the choice between buying a bond or buying equities, and I'm not overly bullish in equities. I'm looking at maybe, if we do have an up year this year, it being like another 5 to 10% from current levels. But equities are much, much more appealing, especially in this low kind of interest rate environment. Now, there seems to be this argument that if we are going to see higher inflation, that equities are going to, perform well. But that's not the case. That if we do get some kind of stagflationary period, actually you're going to want to be in commodities and gold and precious metals, and equities probably won't collapse in that kind of environment, but they'll probably flatline. So if you're someone who believes that we keep in this low interest rate, the U.S. economy keeps recovering to the end of the year, you'll probably be okay in equities. But if we get into more of a stagflationary type environment, which I think is going to happen in a year or 2 or 3 years, something in that realm, you're probably going to want to be in physical commodities and gold and precious metals.
More with Dave Skarica next on This Week in Money.
Molycorp Gold Corp has substantial assets. Magnesium deposit, inferred 52 billion pounds. Molybdenum deposit, indicated 1.9 million tons. Inferred 1.8 million tons at 0.087% MO. Past silver producer, average 182 ounces per ton. Trading symbol, MOR. Website, molycorp.com, or phone me, Larry Ray, at 604-531-9639.
This Week in Money is archived online at talkdigitalnetwork.com.
We're talking to David Skarica from addictedtoprofits.net. And let's review gold this week, 1724, silver 33. They've had a pretty good run this week.
If you look at, for example, silver, we're kind of in a basing mode from the blow-off of last year. We had this move to $50. We actually got basically cut in half in silver to the mid-20s. Now we're really in I would say almost in a range from the late 20s to mid-30s. Now, when you have the kind of blow-off you had in silver, and it was about this time last year it started, I figured we would need about 12 to 18 months of this kind of basing consolidation in the 30s, low to mid-30s, before we move significantly higher. So silver, if we continue a continuation of the precious metals rally, it could get into the mid to late 30s, but I'm not really looking at attacking that $50 high to sometime later in the year or early next year. I think we still need kind of this, 2 steps up, 1 step back kind of performance in silver until we kind of work off that excess kind of blow off that it had last year. But, I still think longer term, now if you're looking 2, 3, 4, 5 years out, I think, I'd rather buy silver at 33 than gold at 1,700. Because remember, for silver to go up 50%, it just has to go back to 50. For gold to go up 50% from current levels, it'd have to go to roughly 2,500, which would be, well into new all-time high territory. Yeah. So I actually do like, in the shorter term, probably gold, But in the longer term, I definitely like silver better at these levels.
What are you seeing in the gold and silver equity markets? You're still seeing some divergence between the juniors and the seniors?
I actually like what I'm seeing in the junior market. The seniors are very difficult right now. Stocks which are doing takeovers are really lagging. There's been stocks like Agnico and Kinross have had some really bad news as of late, and they're big parts of these indices, and that's why these gold indices are lagging. But on the other hand, a lot of gold royalty companies are really performing well and actually have broken out to new highs in the last few months. So it's kind of like a tale of two markets in the senior golds. But the juniors are quietly propping up. They underperformed when there was a lot of liquidity worries or what was going on in Europe last year. But for example, when a lot of these seniors have been choppy in the last month or two, the juniors have actually continued their rally for most of the first, roughly 45 days of this year. So I actually think that outperformance is going to continue, and I think what's happening, especially with, like I said, some of those negative earnings, is people are saying how difficult it is to run a senior company, and like the fact that you've got to manage, maybe half a dozen to a dozen properties, and if one or two don't work out, that can really hurt earnings. Where junior companies, just exploring or mining one or two minor properties, and it's easier to manage, and I think they're going to benefit from that. And if we look at things like the TED spread falling and liquidity returning to markets, juniors are beneficiaries of that liquidity.
David Skarica is author of The Great Super Cycle, Profit from the Coming Inflation Tidal Wave and Dollar Devaluation. And you can find Dave online at addictedtoprofits.net. Dave, thanks for talking to us, and have a great weekend, sir.
You too. Thanks for having me.
Our thanks to our guests, Andre Gerolymatos, John Rubino, and Dave Skarica. And thanks to you for listening. I'm Phil Mackesy. For AmericanManganeseInc.com, we're back next week with another edition of This Week in Money.
This Week in Money is a production of Howe Street Media Incorporated.